Wow, that guy ran a long time talking about return. Well, now for the live portion. What we're going to do in this session is take that last part. So I spent a good portion of that previous hour talking about the different facets of the return on the portfolio. And the whole point, the title of this session is, benchmarking return. We want to make sure we're quoting the right number. We understand all those from the forecasting, the gain loss, whether we're using book yield or total return, all those different things I mentioned, and that we're quoting the correct return on the portfolio. But when we're asked, well, how are you doing? How's the return on this portfolio compared to, what is the answer? How do we fill in the blank there? What do we compare it to? And so what we're going to do here is I'm going to have a spreadsheet, and all these files will be able to be downloaded from the CDIAC website. And by the way, as we're recording this, so I'm going to go through, as you can see, on points 1 and 2 here, and go over the weighted equivalent bond benchmarked answers to that question and what they mean and how you can use them in a sentence, and then show you where you can get them by hand. And then I want to talk about, that would be from Fred, and then we're going to talk about how we can use Excel for some capital for labor substitutions and start using this methodology for more than just 1 or 2 bonds and do it across any number of bonds. Of course, that means setting Excel up, as you can see here with all these tabs. And you will be able to go back and you'll be able to replay this and stop and zoom in and make sure you didn't miss any of the finer points, especially when preparing Excel. But first things first, we have a return on the portfolio. How are we doing? I think there's several answers to that, and I'm going to use the GFOA sample investment policy here, and I want to point out a couple of things. I think the answer to that question, the return that the portfolio's return should be compared to, is actually built into the investment policy. So I'm just going to zoom in here, and this sentence, the objective will be to mitigate credit risk and interest rate risk. Now mitigate is often interpreted as eliminate, and it's really not. Mitigate, as you can see here, means just to make less severe, right? Less severe. It doesn't mean to eliminate. Eliminate literally means to just get rid of, but the investment policy, if your reads like the GFOA sample investment policy, is really tasking you with mitigating it. But I think that idea of eliminating it can help someone understand, especially external stakeholders or internal stakeholders who are not versed in finance, how to think about the return on the portfolio. And so I think I'm going to give you the first 2 answers in this 30-minute session we have here that deal with this. And on a weighted equivalent bond benchmark basis, I think the first one is to show the return on the portfolio versus having eliminated credit risk and interest rate risk. And so how would we do that? Well, if we have an example here, let's say we just have one bond in the portfolio. This is a bond that we bought back in December 2016, end of December 2016. It matures at the end of this year, so it has roughly about 1 year left. At the time of purchase, it was a 5-year bond, and we earned 235. Well, the weighted equivalent bond benchmark no risk return, meaning that we've eliminated interest rate risk and credit risk, not just mitigated, but we totally eliminated them, would be the risk-free rate. And the risk-free rate is usually considered to be the 3-month Treasury bill, not LAIF, not whatever your state pool is, but the 3-month Treasury bill. And what I would do is I would want to know, well, if I didn't take the portfolio and have it in this security, earning me this 235, as we saw from the presentation, that 235 every time we get a coupon payment, that's what we're earning, right? No matter how the market values fluctuated up and down. Of course, if we owned it we bought it at 235, and what's happened lately, this bond has a substantial gain in it. But barring that, how can I think about, well, what was the next best alternative? Well, the next best alternative was to take no risk at all, to not just mitigate credit risk and interest rate risk, but just to eliminate it. And that involves, I think, what the average rate would have been between your original purchase date and today. Because as of today, we're still earning a 235 on this, right? But if we wouldn't have done that and we'd have just rolled the money in a 3-month T-bill from the original purchase date of this bond to today, what would we have earned? Well, we want to have access to Treasury rates. And the best place to get access to not just yield data, economic data in general, is the Federal Reserve Economic Database. Now, I want to point out briefly, if you have a Bloomberg terminal, I'm going to go to my Bloomberg screen here, you can find this information on Bloomberg. And there's a nomenclature for these rates on Bloomberg. The 3-month T-bill is CMAT03M, and then you would hit index go, right? And you would be able to pull up a graph for this, put in the time period. So the purchase date was December 30th, 2016 to today, and the average rate was a 133. So the way to think about this number is, if we would, I'm going to type it in here, if we would have just taken that money and we'd have just rolled it in a 3-month T-bill instead of having purchased this bond, this was the rate that you could have gotten at the time on a AA piece of corporate paper back in December 30th, 2016. We could have just had a 133. That would have been our average rate, roughly about 100 basis points less than what we are earning on it. But if you don't have a Bloomberg terminal, how could you find that answer? Well, I said, the Federal Reserve Economic Database. And so what I want to do is I want to show you, if you don't have FRED, it's fred.stlouisfed.org, and CDIAC will have some of these links posted as well in case you miss it. FRED has tons of data. And one of the things you can do is you could type in constant maturity Treasury, or if you're unsure, just type in Treasury yield, and you'll start to see a lot of the different Treasury yields pop up. Now, you don't need, so there's this one. You don't need to do that. I'll have all that in the spreadsheet and here. FRED assigns variable names to all their economic and interest rate data. And so for this one right here, what I want you to notice is this is that variable name there. Now, all these are in the spreadsheets. You don't need to worry about that. But if you're looking it up by hand, you'll want to know what the correct variable name is. And so what I've done here is you pull it up, get a graph, and now I've typed in December 30th, 2016 to roughly the last business day, which was the 14th. And now I want to know, well, here it is, but what is the average? Well, you could download your data set here if you don't want to use the FRED add-in that we'll talk about in a second. And you can download it. They'll put it right there. And then you could open it in Excel. And then you could just simply highlight the entire series. And you can see that the average right here is 1.33, and it trails off. So that's another way you could do it. You could answer that question, what was the next best alternative? We've been implementing this investment program at our entity. We didn't have to do that. We could have simply just rolled the money and not just mitigate interest rate risk and credit risk. We could have done nothing with the money and taken no risk, no credit or interest rate risk whatsoever, and we would have, on average, earned 133 over this time period. The next answer to that question is what I call the no credit. So in other words, let's say we took no credit risk, meaning we were just going to buy treasuries, and also there's no optionality risk. We're not taking any other risk. We're just buying treasuries. We would want to match the maturity matched treasury at the time of purchase and see what its yield was. So back on December 30th, 2016, this was a 5-year maturity. And we want to know, well, what's the 5-year treasury rate? We could have bought a treasury instead of just rolling cash each month, which would have given us every 3 months would have given us an average 133. What if we had just bought a 5-year treasury instead of buying this generic AA 5-year corporate at the end of December 2016? We want to know what the 5-year treasury is. That also will be FRED. So you can come over here and Fred, you can see the variable name here is DGS5. And now what you can do is you can just type in the graph here. We did December 30th, and you could come and say, well, on December 30th, the rate was 193. When you put your cursor over the graph there, I'll zoom in here so you can see it, and you'll be able to see that it's right there. So what happens? Well, you can also download it if you want, and you can look it up manually. So you download again. You can always get all this information off Fred by looking it up manually, just downloading the data. And when it downloads it to you, it's going to put it in a nice CSV or an Excel file. The Excel file has a little more header information, so the CSV I find is a lot better. But you could just come down here and you could say, yep, December 30th, 2016, it was a 193. And that's what we get done. So I think those are two really good answers. And they help explain, when we think back to the investment policy, we're implementing an investment program in our entity, which means we're likely taking interest rate risk, credit risk, and if you're buying callables, there's optionality in there, there's call risk, reinvestment risk. We're earning a return. What were the next two best alternatives if we eliminated both credit and interest rate risk, or we just eliminated credit risk? And it can give them an understanding of what was the additional pickup that we're earning in the portfolio on a return basis versus the return that we're actually earning in the portfolio. And it keeps it apples to apples, meaning it is both, since I have one bond here, it's weighted similarly, and it's equivalent to my purchasing pattern. It's not just some fixed income index that gets rebalanced each month, whether you're going to use the yield to worse off that as a proxy for book yield, or you're using the total return. And it's not, although I appreciate the simplicity of a 12-month moving average of a 2-year treasury, and that is very helpful, and it's I don't want to make the perfect enemy the good. That too is equal 12 allotments of a particular treasury, but it isn't weighted or equivalent to the amount you're buying or your purchasing pattern. And this can help give a much more direct, comparable result. Well, as you can imagine, if you had more than one bond in your portfolio, going to the Fred website and doing this manually for each bond would really be problematic. So one of the things you want to do is it would be very helpful to have Excel be able to pull that information for you. And you're lucky, our friends at the Federal Reserve, and you can see I've clicked on my Fred toolbar here in Excel, have created an add-in for Excel that can help you not just download treasury yields, but all kinds and all manner of economic data. If there are not just government data, but private companies will put their data in here too. You can do a data search. Once you have the add-in, you can look at popular series. You could browse by data popular for our country or for the U.S. alone, prices, money and finance. You can see there's all kinds of stuff here that you can do. And you could automate the downloading of this data by creating a matrix. I call it a Fred Webb matrix, where you can create this matrix, and then when you go to Fred and you do update, this matrix will update for you automatically. But of course, the key is getting the Fred add-in into Excel. Now, you're going to want to consult with your IT department. You're going to want to make sure that they're okay with the Fred add-in and that it passes all the security requirements that your entity has or your firm has. It usually does, but this is an add-in. It doesn't cost any money. As a tax-paying citizen and entity, you've already paid for it, and you can download it. So we're going to go through that right now and show you how to download that. So I'm going to go to the Fred website. Now, let's say you don't know how to find this. Well, one of the things you can do is you could just type Fred Excel add-in, and one of the first links that pops up will be economic data add-in in Microsoft Excel, and you'll be right here. So what you'll want to do is you'll want to, of course, agree to the terms, and I'm going to go through this step by step with you. Remember, don't worry about writing all this down right now. You can go back and stop this, but your Excel will need some preparation. So what you want to do is you want to just hit download. and that's going to download. I'm using Chrome, if you're using Edge or whatever, you want to go there, show in folder, and then it's going to download it as a zip, and you just want to double click on that. And so you'll see that there are installation instructions, update instructions, and then there is the add-in. XLAM is an Excel add-in. So I'm going to minimize my browser right now, and I'm going to close this spreadsheet, and I'm going to open up a blank workbook in Excel, because one of the things you have to do is you have to make sure that the place where you're going to put the add-in is a trusted place or a trusted location in Excel. If it's not, then what happens is when you come back and you load your Excel up, the Fred add-in won't be there. You'll have to go back and redo this routine over and over again. So what you want to do is you want to go to File, and you want to come down here and you want to go to Options. And then when you see this Options screen, you're going to see a lot of stuff here, and you want to go to Trust Center. And you want to go to You're going to go to Trust Center, and you want to add a directory for it to trust, so it doesn't have to eliminate it each time or ask you, should you trust this each time. Now, that directory that you want to add to trust is actually going to be a directory that you can locate by going to add-ins. And this is going to also show you something. If you're an Excel user, there's going to be some things here in your add-ins that you may not already have loaded that come by default with Excel that also is worth checking out in addition to adding the Fred add-ins. So click on the add-ins, and then you want to manage down here. It says go to add-ins. So we want to go to Excel add-ins. Now, by default, the Analysis Toolpack VBA, ignore the Bloomberg. If you don't have Bloomberg, it won't matter. If you have it, it'll already be turned on if you've installed it. And the Solver add-in come by default with Excel. If you don't see it on yours, that means your network administrator did not put them out there, and that is something you want to have access to. The Analysis Toolpack and the Solver add-in are very powerful tools. They're beyond the scope of this, but you would want to have access to them and allow those add-ins to be loaded up in your Excel every time you load it up. But what we're concerned about is the Fred add-in. Now, I've already done this, so where's that directory at? So if you just click Browse here, it's going to show you, you're going to have a window pop up, and yours may be different than mine. Now, I'm not going to be able to memorize all that, and neither are you, depending on where it's at. What you want to do is you want to click in here, and it'll highlight it. Now, what I'm going to do is I'm going to hit Control-C, and I'm going to copy that directory path. Now, I'm going to hit Cancel here. Then I'm going to hit Cancel here, and then I'm going to go back to this Windows Explorer here, and I'm going to open up another Windows File Explorer. And then where it says Quick Access, I'm going to click up here, and I'm going to do Control-V to paste, and I'm going to take myself right to that directory where the add-in is at. Now, you can see I already have the Fred add-in here. You won't have anything there if you haven't done this, and you want to right-click and just copy the Fred add-in to that location. Now, once you've done that, the Fred add-in is there. You want to go back to Excel, go to File, go to Options, go to Add-ins, go, and you want to make sure that Fred's there, and then it's checked. And then you hit OK. Now, once you do that, you'll see the Fred ribbon bar here, but you're not safe yet. As I said, you need to go back to Options, File, Options. You need to go to Trust Center, go to Trust Center Settings, and then you want to do Trusted Locations, and then you want to add a new location. And now, if you haven't gotten rid of that, you want to paste in that location that we copied from the Fred add-ins, and you want to make sure you check this right here that it says subfolders of this location are also trusted. And then you want to hit OK. Now, I've already done this, so I'm going to hit Cancel, and you can see that I've already added this back in May to this Excel. Now, once you've done all that, you hit OK, back out. Now you completely have the Fred add-in and the Fred ribbon every time you load Excel up, they'll load it there. They'll know that it's a trusted location. You have access to this wonderful Fred add-in. So that's how to get it. What's some of the things we could do with it, specifically in answering this question about the weighted equivalent bond benchmarks? Well, I'm going to close this down. I'm going to open up the spreadsheet for this, the Fred Webb Matrix template that you should be able to download from the CDIAC website. And I want to point you to, so we saw that this was a 133 and we saw that that was a 193, right, the average there. But I want to show you something I've set up now. In Fred, and you can read this in the directions, there's a way to set up variables that you can have Fred update by going to Fred and get Fred data. Now, this creates a matrix. This is literally the Fred matrix portion of this. And here are all the variable names. I want to talk to you about the color coding on the spreadsheet when you come back and look at it so you know what you're looking at here. Anything in blue is something I've typed. Anything in blue that's highlighted in yellow is something that you could type over. I don't suggest messing with this because these are the variables that Fred's going to look at when you hit update that tells it how to update this matrix. But to give you an idea of how this matrix works and how you can search data and think about it as interpolating or looking up a yield curve, I've created an example of an interpolated yield curve. If you just come over here and you type, for example, 5/15, let's say 2013, and you want to look at a yield curve, it's going to go and it's going to find a yield curve that's closest to 5/15. So 5/15 actually happens to be the date, and it's going to pull the yield curve for that date. So let's say we didn't have a 5-year bond on that date. We wanted to know what a 3.5-year bond is. This right here shows you how to both interpolate and manipulate the Fred Webb matrix data when it pulls in so you can get the yield on a specific maturity, even if it's not across the yield curve here. Now, there's a lot of formulas here. My formulas that I love in Excel are index and match and offset. And if you have any questions about how the spreadsheet's constructed, you can reach out to CDIAC or reach out to me directly. My contact info and email is on the front of this sheet here, along with a nice disclaimer saying that if you find anything great about this, Piper wants you to remember them fondly, and CDIAC does. And if there's something you don't like about it, the sending parties, myself, will be punished accordingly. So the Fred Webb matrix, along with the Webb interpolated yield curve, can help you, and when you look at how this is constructed, can help you create a formula, formulas I've used here, that can help you solve it, not just for one security, but for a number of securities. So for example, we're going to meet after today on Friday, and I wanted to give you a little bit of a homework assignment. And when you download the spreadsheet, I want you to go to the example tab, and I want you to think about how you would use these two weighted equivalent bond benchmark returns, the no risk one and then the no credit risk one, to answer the question, well, how does this portfolio of these hypothetical 3 securities, 50% in the AA corporate that was a 5-year when we bought it, and then 20% in another one, and then 30% in LAIF. And how would you answer that question? How could you change this up one? How would you look at this, and then how would you do the computation to give us what the alternative would have been if we did nothing and we just put all the money into the 3-month T-bill, or if we did something other than take no credit risk and we just took interest rate risk by having a portfolio of maturity matched treasuries. Now, one of the other spreadsheets for that portion dealing with LAIF, and in LAIF, unfortunately, LAIF rates are not part of Fred. I'm hoping that they'll add it sometime in the future, but they're not. And so what CDIAC is going to do is I've created a historical LAIF web query that will automatically update LAIF rates by doing a web query, which is beyond the scope of this demonstration here. But if you want to know what the lay fields were on a monthly basis, average lay fields, which come from the LAIF website here, PMI average monthly effective yields. That Excel spreadsheet pulls this matrix in here, a raw web query, and then this formula here and these columns here have the monthly dates and the rates. This is set to go all the way to the end of this year as well. It will update every time you open it. So with those two spreadsheets there, I'm looking forward to talking to you tomorrow, and I want to see how you would answer the question of how can I create that no risk, what we've done if we just did nothing, and how would you answer it giving this portfolio of 3 hypothetical securities, and then if we'd have taken no credit risk, no reinvestment risk, there's no callable bonds, and what would the no credit, no optionality risk version for the weighted equivalent bond benchmark return be as well. Thank you, and I look forward to talking to you tomorrow.